Now joining us, Sameer Dalal, CEO, Natwarlal and Sons Stockbrokers. Sameer, hi. How do you look at the current market? We saw last 2 days a lot of short covering which is happening, and that's one of the reasons why the market has bounced back from the lows. But do you see enough support coming for the market?
So there will always be some support for the market because of the kind of liquidity that sits with the mutual fund industry. The question we got to ask ourselves is this support a justified support, or should the market actually be trading at multiples that are slightly lower, right? So for me, I'm in the second camp. I think the markets should be a little bit lower given where we stand when it comes to growth, when it comes to inflation, given the fact that, FY27 is going to be a really difficult year when it comes to numbers. Yes, I understand markets are forward looking and people are projecting FY28 and saying, once the things end, then yes, FY27 will be a low base and then FY28 will be growth. All of that is well and good. But the fact remains that we do not know what can change in the next 6 months. We have a person in power in the US who is quite whimsical and changes his moods, changes his mind quite easily. And for all practical purposes, the growth that we're projecting in FY28 may also kind of evade us, right? So for me, yes, markets will get support at lower levels given the kind of liquidity that exists. You're getting some blue chips which are quite well priced. For example, Reliance has seen a sharp correction, which is given the listing of Geo, given the fact that the refining business will show good profitability once things ease up. Uh, then you have HDFC Bank, which is attractively priced. So there is a reason for support in the market, but I feel it's being done probably too early, and the markets could be maybe 2 basis points lower when it comes to PE multiples.
Interesting. Of course, Hindustan Copper Management, but Sameer, curious to know how you're looking at the metals trade right now and whether after the meaningful move, are they still investable?
So honestly, Aisha, I've said this on I don't know if I've said this on your channel yet or not, but metal sector, when they are rallying and when metal prices have moved up as much as they have, that's a sector I like to stay away from. For the simple reason, when they move up, what you see is the profitability starts increasing and the valuation multiples start looking cheap. And this is because they get the full benefit of all the price increases that happen, especially when you're vertically integrated in the likes of Hindustan Copper or a Tata Steel, to some extent a JSW Steel. But what happens is, commodity cycles are self-killing in nature. When they rise too much, prices move up too high, too fast. It kind of hurts the demand side. And when that starts happening, the prices start coming off. And then what happens is the operating leverage or the profitability starts working negative because you're making all the money right from the beginning to the end, right? So if in a case of a Hindustan Copper, in a case of a Tata Steel, when you're mining the ore, when the prices go up, that full benefit from ore to steel entire vertical you get. And the the EV by EBITDA, what they look at for companies in the commodity sector start looking cheap. So I have a very clear theory when it's the best time to invest in commodities is when the cycle is at its worst, when the valuation multiples look ridiculous because there's no profitability to speak of. And the best time to get out of a cyclical business is when things are looking rosy, when valuations look attractive, because that is when things can start getting worse. So for me, if you ask me, commodities is a sector that we are actually choosing to take money off the table. Yes, this cycle may turn out to be a little bit longer given the geopolitical situation that exists, where certain supply side issues have cropped up, but they will eventually resolve themselves. And once the supply resumes, then the pricing power goes away from all of these players. And then, you get stuck with something at a much higher level, which is difficult to make money out of. So for me, do these stocks in the short term have upside? Yes, but in the long term, I think it becomes a risky investment to take because if you don't sell at the right time, you're going to get stuck on an asset which is probably going to bleed you out for many years after that.
Right. Okay, Sameer, stay with us. Lots more.
How do you look at some of the real estate players? Puravankara came out with a decent set of numbers, back to profit. Uh, but with what we are seeing is that the kind of pre-sales announcements that these companies are making are not able to, these companies are not able to convert them into executed deliverable square feet on the ground. How do you look at some of the real estate companies?
So I wouldn't say they've not been able to deliver them to sales on the ground eventually. Look, there is an issue when it comes to certain things that happen in pre-sales. I'm sure you're well aware where these large blocks get sold off, when the pre-sales happen to institutions at a particular price to ensure that they get the money for the construction activity. So for me, real estate is still a story, a structurally strong story in India. Yes, the mid-market segment is taking a bit of a hit and probably will be in a lull period for the next year and a half. It's two segments that we believe will be the drivers of for the real estate segment. One is this premium and super premium, where sales will remain very strong, as you have seen. And then the affordable segment is something that I think where you will see. Now, companies that cater to those segments more, that would be in the larger metros, which is your larger players like a Godrej or a DLF or a Prestige Estates. I think they will continue to do well. They will get their sales. The cash flows will start improving because the cash flows continue to improve as the project keeps getting developed, right? As the collections keep happening. So we will see all of the pre-sales that have happened over the last 2 to 3 years generating cash over the next year and a half to 2 years. And that is, I think, when probably the re-rating of the sector will start happening again. We've seen a very sharp correction across the board when it comes to the real estate space. Stocks have fallen as much as 60% from their high. I think Godrej is one of them that went to 3,400 or 500, if I'm not mistaken, and is down right now at, I think, 1,600 and something. I don't know the price as of yesterday, but it's fallen by almost over 50%. And then you have Prestige, which has made a high of 2,000 down. Oberoi is down. So all of the large players have seen a very sharp correction. We believe the cash flows will remain strong. India still has a huge opportunity of growth. The two problematic points in the short term is one, prices had moved up too fast in the mid-market segment, so that has affected sales. And two, we are in a situation where inflation is on the rise, so interest rates may not be able to be cut. In fact, may be forced to be risen again. And in that situation, real estate never does well. So maybe a 1 year lull before you see another run up. But these counters are showing me good opportunities from a longer term perspective to invest.
Interesting. Yeah. I mean, realty has been a massive underperformer all through last calendar year as well. And then, of course, in the recent correction up until up until March. But that's that on realty. We'll take a very quick break and we'll come back and continue our discussion with Kunal Bothra and Sameer Dalal.
How do you look at the private sector banks, HDFC Bank, ICICI, and Axis? We've seen a muted performance from a stock share price point of view, and after the SBI results, the entire banking industry has been in a correction mode.
Yeah, so the private sector banking is a space that we are very, very bullish and very positive on. So let's talk about individual stocks first. So let's take HDFC, right? HDFC, if you look at it over the last maybe, I'll go back as long as 4 to 5 years, the stock has really not generated any kind of major returns. The returns over a 5 year period, maybe as low as 4 to 5% CAGR, right? The valuation multiples, the bank, which used to trade at about 3.5 to 4 times, is down to about 2.4, 2.5 times, which is in line with what some of the other banks are trading at. And this is all after the merger with HDFC. But the real story for HDFC is still to play out because the reducing of the cost of funds of HDFC Limited will start playing out. And then once that is done, the growth story will keep happening. We believe the banking space is a space that will do well because for India to grow, India to develop, India to move forward, funding is a requirement. So the entire banking space will benefit. And who benefits the most when all of this happens? the guy who has some of the lowest cost of borrowing. And that, i.e., one of them is HDFC Bank, the other being SBI, Axis and ICICI follow. Then you have to also look at, apart from the large players, you also look at guys who take a little bit of risk on their book, right? Their cost of raising money is a lot more expensive. So you have the likes of IDFC, IndusInd, RBL, Yes Bank, whose cost of borrowing is higher because their CASA is the CASA rates that they offer are higher. So they take a little more risky kind of proposition when it comes to giving out loans, and they earn a higher NIM, but their credit costs are higher. We think that space is also something that will keep developing and keep growing because the constant requirement of SMEs to grow is going to come from the debt side. So I think banking is the one space where I can truly go out and say that if you have a 2-year view, just go out. Don't forget stock picking. If you don't want to stock pick, just buy the bank ETF. I think over the next 2 to 3 years, you will make money. If you want to be more specific, I think you can outdo the bank ETF if you buy stocks where valuations are attractive and growth is going to return. Simple case and example is an IndusInd Bank where the stock has taken a massive knock. Something like that can easily bounce back and give far higher returns than the banking index.
Yeah, in fact, talking about banks.
Sameer, your thoughts on IndusInd Bank? We have a new management in place, but the old issues are still lingering around.
Yeah, absolutely. Some of the old issues are there, and whistleblower complaints that come in fast. I mean, that these are great things that can happen for checkpoints, right? So you can ensure that there's no more mess. Look, after what happened last with IndusInd Bank with the treasury losses, which were the foreign exchange treasury losses, which were being hidden or manipulated, and the bank had to take a massive write-out. They've gone through probably so many different accounts of theirs to ensure that there are no more one-off surprises from the past. So according to me, I think all the pain has been looked into and addressed. Now the new management's agenda is very clearly grow the book, grow it profitably, uh, see that there are no more mishaps along the way, and then the valuation re-rating happens. So that is where we think that a lot of the pain is already in the price. It's trading at one-time book as a private sector bank with a very strong franchise reach, good branch reach, great large size book. Then they have the MFI space, right? Where they bought Bharat Financial. Bharat Financial has the MFI space over the last year and a half has gone through a very tough patch because of the rise in the NPAs, RBI changing rules. There cannot be X number of lenders. The lenders then you have to provide. So all of that pain is done, and now what you're going to see is the loan book growing. Now this is a book that can generate you much higher yields, increasing your NIM. So what you saw in IndusInd Bank was loan book not growing, yields coming down, the NIMs coming down, profit provisions rising. So on all fronts, the hit came. Now we are going to see it reverse, and when it reverses, that's when people will start re-rating it over the next 2 years. So you get not only the growth story of maybe 10 to 15% loan book growth, plus a re-rating story with maybe a 50% increase in the valuation multiple from one-time book to 1.5 time book. So that is the story I'm saying is going to play out for something like an IndusInd Bank, which you may not get for some of the other banks which are fully priced.
Kunal, your mid-cap picks for today?
So from the
IT stocks, IT index nearly 6% up this month. Do you think the selling in IT is over now? We are at the rock bottom from a valuation point of view, and it's only fundamentals which is going to govern for any stock rise from here?
So ideally, I'd like to tell you, yes, I feel the valuation multiples have bottomed out. But look, there are two ways of looking at it. The first is that we are trading at historically low valuations, IT at 15 times X. These are very high cash flow generating businesses. I personally also believe that, given the 5% div payout and maybe like a 3 to 4% growth in the company's businesses warrants the fact that these stocks should not correct more. But the fact still remains that if you look at Cognizant, which is a similar services businesses that exists in the US, which caters to the same markets that the Indian companies cater to, trades at 10 times earnings versus our Indian peers trading at about 15 times earnings. So if I am a foreign institution holding an IT stock, why should I take a risk of holding an Infosys or a TCS, which is trading at 15 times versus not selling the shares here where I'm paying a higher price. I mean, I'm risking myself for currency as well and going out to the US and buying a Cognizant. So the probability is that you might continue to see a further bit of selling from the FIs in the IT sector. Second, a big thing change that has happened is, we all kept believing that Indian IT would play a great role in the implementation of AI services in companies' ERP models and in their business models. But the more we read, and last week also, why one of the reasons the stocks corrected was the AI companies are releasing tools which will help companies integrate their models into their services. Now, I'm sure you need some amount of work, but what it does is it keeps reducing the need for Indian IT, which is providing employees time as a service, right? And if that reduction keeps happening over a period of time, then Indian IT starts to lose its relevance to a large extent. And then the question comes is, will we even be able to maintain, forget growing, will we be seeing a degrowth in the top line? So we are rallying on the fact that the currency has declined, because of which EBITDAs will be stronger, profits will be better. But that is not something that we should be talking about and being proud of, because if the rupee stops falling, then your profitability doesn't keep increasing. You need your top line to increase, and that is becoming a question mark. So at the moment, IT, yes, valuations are attractive. Can they fall further? They can. I personally would like to say yes, 15 times min. It should not go below that. But the probability, like I said, is because of what the global standards are, it could go down further.
Sameer, there was a time that the second tier IT companies were trading at 35 times earnings, and now there's a sudden derating of nearly 10 PE. And now they're trading at 24, 25 times. Is that the normal one for them? And the tier one, which was trading at 23, 25 times, is now at 14, 15 times.
Like I said, I hope to think that 14, 15 has become the new norm for the time being. I don't know if it is. But look, see, eventually what happens is everything is related to growth. Today, we don't have visibility of growth. So 14, 15 seems like a fair number. Tomorrow, for whatever reason, if Indian IT services, that is the employee-based work, needs more demand, comes from more demand because of the implementation, maybe the tools are there, but still companies are not able to do it. And then you need someone to service it. And if that demand starts seeing an uptick and you see growth coming in, then 14, 15 may not be the norm. Then if a company can grow, an IT company which is cash generating can grow at 10% a year, uh, uh, I think giving it a 2-time PEG is not difficult, and then 20 could be the right PE. Smaller mid-cap IT companies were growing at a much faster clip because their base was smaller, right? It's not about whether they were, if you look at it on an absolute basis, TCS was growing its revenue in rupee term or dollar term more than what Persistent or Coforge were growing in dollar term or rupee term, but the percentages were higher. But now as the mid-cap IT does become a little larger, obviously the growth rates are going to start tapering down. And when that happens, obviously your PE multiples start tapering down. So is 25, 26 the new norm for them? If growth rates come down below 15, 14, 13%, then maybe even they will see 20 times and not 25 times. So it's all a factor of growth. And the problem, I honestly say, is I don't see the growth, at least for the next 1 year. Companies themselves are struggling to give a guidance. So I think it's going to be played quarter to quarter. And if something changes positively, re-rating up. Otherwise, yes, these could be very well the new going rates.
Thanks, Sameer, for joining us today. Kunal,